to this short educational video on what exactly IP or income protection is and how does it work. At the Income Protection Task Force, we believe that income protection should be at the cornerstone of any financial conversation you have with your clients. I'm Richard Kateley and I've worked in the insurance industry for over 30 years. And it's only in the last few years that I've noticed that income protection has gained the prominence that it demands with both providers and advisors alike. If you're still not convinced about the importance of it, let me ask you a couple of quick questions. What and why do you insure things? Seems a simple question. Most of the time when we ask the general public this in research, they come back with saying we either insure high value things or things that would cost us a lot of money to repair or replace, like car insurance in case we have a car crash, buildings and contents insurance in case we're burgled or the house burns down, or obviously pet insurance if my animal needs a medical procedure. It gives them the peace of mind and gives them the finance to cover the cost at a time when they might not have the spare cash. And it's that peace of mind which I think plays a huge part in any sort of protection we take out. These things make sense, I guess, these replies from the clients, and if you agree with the basic premise that we only insure things that are really high value or really important to us, let me ask you this. Do you insure what is, I class, your biggest asset? I guess to answer that first, you have to first work out what your biggest asset is. And again, when we've been out on countless bits of research to the general public and asked them that very question, they come up with usually the top three answers are my home, which is probably obvious, so they think it's their biggest asset, my car, or my savings. What would you say? What would you say is your biggest asset? In reality, I believe your biggest asset is likely to be your ability to earn an income. Don't believe me? Well, let's put it this way. The average household in the UK is worth just over £232,000. The average car, just about £10,000. And the average household have savings amounting to about £2,700. Now, according to the UK survey from the Office of National Statistics in 2021, the average salary in the UK is around £32,000. So let's take a 25-year-old. They're going to work to 65. That's 40 years. Let's do the maths. Let's times 32 by 40. That gives us a grand total of £1.2 million. Now, I don't know about you, but that's a pretty large asset. And most clients don't know or never considered insuring it. So, what is income protection? Well, before I answer that question, let's be very clear about what it isn't, okay? It is not payment protection insurance, or PPI, which everybody's heard of and got a lot of bad press over recent years. But clients get confused about the two, and we have to make it very clear to clients that there's a difference. PPI was a short-term insurance product which was designed to cover specific payments on, say, credit cards, bank loans or mortgages. And it's quite often sold without the clients even know they had it. So PPI is not income protection. It's also, income protection is not ASU, or accident, sickness, unemployment. Now, both policies pay out very similarly and if you're unable to work, but ASU is an annual policy, so the insurance company doesn't need to renew it every year. And it also only offers a short-term protection to the loss of your income, so between 12 and 24 months. Whereas income protection offers much longer term and can pay up to 70% of your pre-tax income until you return to work. Now that could be 10, 15, 20 years. One of the advantages of ASU, on the other hand, is that it will pay out if you're made redundant, whereas most income protection policies won't. They're also sold without full medical underwriting, which can be a double-edged sword. It's really good if your client has a poor medical history, but also can mean that you are less certain that you'll get the cover when you actually make a claim. And finally, the one that clients confuse income protection with is critical illness. Now, we all know critical illness is an insurance policy that pays out a lump sum if you're diagnosed with one of the listed critical conditions, which vary from provider to provider. And it will also pay whether you're working or not. Income protection will pay an income, and it will only pay it if you're unable to work. You don't need to go through those long list of conditions that you do with a critical illness. So once we understand and the client knows what income protection isn't, then we can start talking about what it is, right? So what it is it's a product that is, at its core, is just a long-term insurance product offered by a number of the UK insurers, which will pay out a benefit, or an income if you like, if you're unable to work due to illness, accident or injury. There are no long list of conditions which you have to go through to trigger a payout. It's simply if you're unable to work due to this condition, the policy will pay out. Now each provider will offer their own style, their own benefits and their own USPs, and you can find a lot of this information on the Income Protection Task Force website under the provider section, or go to the providers' websites themselves, talk to their representatives and find out what features and benefits they offer. In this video I'm going to go and cover just the core benefits that the vast majority of the providers offer, so you get a good feel about the marketplace. So let's start with the basics, the type of plan you can have. Now there's three that you really need to consider. Firstly, it's the standard plan. The benefit is paid after a deferred period, which I'll talk about in a minute, and it will carry on paying until you either return to work, sometimes when you retire, the end of the policy term, or you die. The budget or low cost, these tend to have a limited benefit period range, so they might only pay the benefit for 1, 2 or 5 years after a valid claim. As the maximum benefit periods are much shorter, this makes the premiums much cheaper, so useful for those on a budget. And then finally we've got age costed. Now these plans have been favoured by the family friendly societies, and they're becoming more and more popular, and as the name suggests, they are costed on the client's age every year. So the premiums start low and then tend to grow throughout the term. And usually there's a swap over period into 10 or 15 years into the plan. So they start low and they're usually very popular with the higher ended occupational classes. But again, we'll talk about that in a moment. So the three basic plans are standard, where the benefit will be paid until you return to work, the end of the policy, or you die. Budget or low cost, where the benefit is limited to 1, 2 or 5 years, and then age costed, where the benefits, again, like the standard plan, can be paid until you return to work, but the premiums are based on your age and go up every year. Talking of premiums, or the cost of the contract, there are again two sorts. There's a guaranteed premium, and then there's a reviewable premium. Guaranteed, as its name suggests, the premiums are guaranteed throughout the term of the contract, and then reviewable. Now this is where the provider can actually increase the premiums based on their own underwriting evidence, not on the client's age or medical, like we were talking about with age costed just now. This was only on their own medical claims experience. So actually, usually they have a 5-year period where the premium stays level, and then after that they have a review period, sometimes every year, sometimes every 5 years, where they look at their own claims experience and then decide whether they need to increase the premiums or not. We then need to consider the term. Well, you would think term would be obvious. We're trying to protect a client's income. Income carries on until they retire, so normal retirement age would seem like a logical place to start. And it is a very good place to start, but not all clients want the policy just to run to cover their retirement. They may want it just to cover their mortgage, or just cover it until the kids retire, or move out from home. So again, ask the clients what triggers they want. As I say, writing it to normal retirement age would seem like the logical thing to do, but never assume, always ask your client. So now we can move on to the benefit. What benefit am I going to get out of this contract? Well, income protection payouts are usually based on a percentage of earnings. Between 50 to 70% is the norm across the marketplace. Sometimes an insurer will pay out a higher percentage on one portion of the salary, say maybe up to 50,000, and then a lower percentage on anything above that. Many providers also cover things like house persons, where you don't actually have an income as such, but the household would need an income to cover domestic help, because the house person can't then do the chores that they would normally do, so they need to get help in. The other good news is that with income protection and the benefit, it is not subject to income tax in the United Kingdom. So again, another good feature of the product. We then need to talk about deferred periods or waiting periods. This is the time that the client has to wait between making a valid claim and the first benefit being paid. Now you can usually choose across the marketplace today between 4, 8, 12, 24 or 52 weeks. The longer the deferred period, the lower the cost will be. What you choose can be affected by the level of savings the clients have, whether they have an employee scheme or their own personal circumstances. But you need to talk to the clients about this, because sometimes their perception and reality about how long they could last if their salary was to stop can be very, very different. Budget planners are a fantastic tool to use at this point, to make sure the client really understands what their outgoings are and what resources they have to cover those outgoings if they really needed to, if their income stopped. It's simply a case of asking the clients to do that calculation and how long would they survive on their income, because most people again haven't really thought about that in any detail. The other thing you can have on the contract is indexation. If you want the benefit to increase in line with inflation, then this can be done by selecting indexation. But remember that in line with the benefit increases, the cost will also increase each year. And also one thing to check here is that some providers will also increase the benefit in payment and others won't if they choose indexation. So if you think you're making a claim, you want your benefit to also increase and you don't want it to be eroded by inflation, especially if you're going to be off long-term sick. So something else to look at when you're considering which providers to use. The other major thing that affects the premium is the occupational class. Now obviously we're protecting a client's income here if they're unable to work. So we need to understand what they do as a job and how risky that work is and if they're likely to be off work. Across the marketplace there tends to be about 4 classes of occupation. Class 1, the lowest, tends to be your professional managers, administrative staff, admin clerks, secretaries, computer programmers, people doing very low business mileage. Class 2 tends to be some workers with a higher business mileage, so maybe a salesperson. Skilled manual workers, engineers, florists, shop assistants, people of that nature. Class 3 tends to be skilled manual workers and some semi-skilled workers. You can also have care workers, plumbers, teachers fitting into that category. And then finally occupational class 4, the highest and most risky, heavy manual workers, some unskilled workers. Bar staff can be included there, construction workers, mechanics. So again, we need to know this information. And again, providers do vary a little bit on how they class an occupation. And the last thing I really wanted to look at was step benefits. When deciding what type of income protection your client needs, you always need to check whether they have an employer's scheme. And again, this can be quite tricky. Sometimes clients say, yes, I've got an occupational scheme, but actually all they're talking about is statutory sick pay, because all companies have to pay statutory sick pay to their employees. What we're talking about here is, do they have a funded income protection plan which will benefit their employees? If they do, some schemes will offer full pay for a period and then reduce how much they pay for a further period. And step benefits can be really useful here and bespoke the plan even further to the client's needs. With this, let's say you can choose 2 different levels of payment designed to pay out after different periods. So let's say the scheme that the client has pays 2 months full pay and then after that, the following 2 months they only pay half pay and then after that they pay nothing at all. Well, you can set up the benefits on the contract so that after you have a 2-month deferred period, after 2 months only 50% of the benefit is then paid. Then after a further 2 months, 100% of the benefit is paid. This is the benefit of both reducing the cost to the client, but also making sure the benefit and the sick pay work together to make sure the client is in a good financial situation and they're not over or underinsured. And then I think for me, the biggest thing that's developed over the last few years is the additional free services that a lot of the providers now offer in the form of rehab or rehabilitation services and back to work assistance. These can really be hugely beneficial to clients. They can offer clients a way of helping them back onto their feet and back to a normal life. If you think about it, a client will have a much longer relationship with a provider with an IP product rather than a critical illness. With a critical illness, there's a single payment and that's the end of the relationship. Whereas with income protection, the client could have a relationship with that provider for 10 or 15 years. And that relationship needs to be strong. The rehab services can really help. They can offer financial help, they can help with advice about changing and developing your home, they can offer extra medical services, they can put you on the right path to more support. And if you go onto our website, you can see just how these benefits can really affect clients in our series of the 7 Families videos, which to me are really, really worth watching. And you can download them for free and show them to your clients. And I would highly recommend that you take the time to go and look at them because they really are eye-opening about how the insurance company with the rehab services can really help their clients during a claim not be alone, because it can feel quite lonely when you're out there and you're making a claim on these sort of policies. But for me, the real benefit of income protection, I guess, compared to life or critical illness policies, is that they offer you a host of levers that you can use to adjust the premium to help meet your client's budget without the need of affecting the core benefit. So if you think about it, with life and critical illness policies, all you can do to reduce the cost and help meet the client's budget is either reduce the term or reduce the sum assured, which may not be the best thing to do. With income protection, you can leave both the monthly benefit and the term alone and change a host of other things. So you could change the deferred period, say, from 4 to 8 weeks. You can make the benefit period shorter by choosing one of the budget plans, which, as you remember, reduces the budget term to 1, 2 or 5 years. Or you can remove indexation from the plan. These options can help bring down the cost to your client that are working with the budget. However, the client needs to understand the implications, and our aim should always be to make sure the client has the cover they really need, not just what they think they can afford. I had a really great story from an advisor once and said, if I can get my clients to fully understand the value of what I'm talking to them, it will always become affordable, which I think is true. I always found it very strange as well in the housing market. We spend an inordinate amount of time trying to prove our income and our affordability when we're buying a home or renting one. Yet as soon as we secure that home, we forget about the one thing that got us the property in the first place, and actually the one thing that will keep us in that property. In other words, our income. We insure most everything, including the kitchen sink, but why not our income? It just seems a little bit strange to me. I've started this video saying how important I thought income protection was and should be the cornerstone of any financial resilience plan. And I'd actually go further by saying that, in my opinion, if we as professional financial advisors do not talk to our clients about protecting their income, then I don't think we're doing our job properly. I also don't think we're doing the right thing by our clients. They may not take our advice, but at least we put them in a more informed position about their protection needs, and hopefully they might come back to us in a few years' time and say, I've thought about what you said and I actually do think I need to protect my income. Income protection doesn't need to be complicated. As I said at the start, at its core, it's simply an insurance policy that if you're unable to work due to illness or accident or sickness, it will pay a percentage of your salary until you're able to return to work. But it can offer so much more. And it can keep some people in their homes. It can help them back to work, and it can be a real lifesaver. And as I said, that 7 Families video campaign, please go and watch it, because it really does ram at home how important these policies can be. And let's hope our clients never ever need it. But if they do, it can be a real lifesaver. So as I say, for more information, please visit the Income Protection website at the Income Protection Task Force. There you'll find a host of information from sales aids, tools, information, blogs from our sponsoring providers and from across the marketplace. Not to mention, as I said, and I keep saying about it, the 7 Families video, which for me really do bring income protection home. I've been Richard Kateley, and I hope you found this short video of use and it will help you on your ongoing training and how you can help clients understand the needs for their income to be protected. Thank you very much indeed for listening.